This is the seasonal stock and ETF report for today, October 10, 2022. Let's go take a look at S&P 500. Again, I've mentioned this last week or two. The reason that our top opportunities are so long-term right now, you see that 201, 187, and so on. We are ranking by Sharpe ratio. The reason they're so long is because we're in a potential down markets right now. Next couple of weeks is going to be very important in what's going to happen. So let's first take a look. Actually, let's just quickly take a look at these. This one is until end of April. Today to end of April, Microsoft tops it. It did lose last year, a little over 1%. Walmart is the next one, lost in 220, but made it huge last year. And my favorite, United Healthcare, lost in 2018, but it's made an average of almost 26% otherwise. It's a great stock for long-term holding. Visa lost last year, but it's made every year otherwise. This is one short-term one that's different than the others. However, you see Sharpe ratio of 1.38. Let's see if it increases. If we wait a little longer, it goes to 1.61. What that really means, the best date to buy this is end of this week, not yet, just a couple days from now. This is purely statistical point. I mean, is it really better in a couple days versus today? Who knows? But statistically, it was better in the last 10 years to buy it at this date, which is the 14th, maybe Thursday or Friday. Now, this is the interesting one I wanted to get to. Take a look at IBM. We've talked about this IBM short for a long time. However, the Sharpe ratio of 1.33, which occurred today for a 16-day out opportunity, is the highest we can get for IBM short, which means in the last 10 years, if you shorted IBM today, which is the 10th, and you waited for 16 calendar days, which is 25th of October, you would have been profitable 9 of 10 years with an average profit of 7.84%. Last year, you would have made 10%, year before almost 12%, 4%, 11%. It didn't work in 2017. But otherwise, look at this. IBM drops sharply this time of the year. Let's look at last 15 years. You look at last 15 years, this is a flat year, 2010. Otherwise, 13 out of 15 years, you would have made an average of 7.19% during this period of time. Is this really the seasonality of this is pretty striking for the last 15 years, but let's look at all of our data. We have 59 years of data. Look at what happens. This is still there. You would have made an average of 7%, 61% of the time in the last 59 years. In these years, early years wasn't as promising, but take a look at last 40 years. 62% profitable with 8.5%. How about last 30 years? 63%, 8.88. This is the time, if IBM is going to drop sharply, this is the time it does it. Here's an anomaly. 2002, it jumped almost 30%. But statistically, this is the time IBM drops. So I am in this trade as of last week, and I added to it when IBM went up to 125. And I'm going to wait till next week based on this time frame, or if there's a sharp drop after the earnings, which is, I believe, the 19th. This usually happens during earning. And I also talked to a friend of mine who used to work at IBM, and I mentioned this to him, and he says, yeah, that used to happen all the time. Sales reps over the summer didn't work hard enough, and I always had bad reports in October. So that was an interesting take from that. This is the time that IBM drops. Do we have any other short? We do not. This is the only one. We go to NASDAQ. Keurig is on the top of the list. This is a great thing to buy. The Sharpe ratio is huge. It's a good stock to buy for long term. We only have 13 years of data, but it's 100% of the time, 13 out of 13 years, it has gone up for the next 90 days. Today, until January 4th, the stock has made an average of 9.5%. Amazing stock. People just drink coffee this time of the year more than other times. S&P 500, top of the list, trans time. It is a long, you see it's on a drop, but it's going back up again. So this might be a good, very short-term jump, maybe an option trade. I'm not sure if it's a good long-term or not. This is only at 28 days we're talking about, by the way. 28 days, 5.3%. Let's go take a look at Crown Castle. Crown Castle historically it's bottomed this week, and then it jumps up and then goes somewhat sideways to up and so on. For some of you that might not know, the seasonal chart shows the average trend over the last 10 years, or whatever number we select over here, we can see the average trend. So we're only looking for trend in these charts. None of these numbers mean that much. Let's go straight to Wilshire today. Trends time is also on the top of the list. This is a very high Sharpe ratio for a 28-day. Actually, I might jump into this myself. Actually, I jump into a lot of these, so they work. Not all the time, but they work a lot more than they don't. I also wanted to go and take a look at shorts. Why are we looking at shorts? I'm going to go and discuss let's discuss that first. Let's go to S&P 500. By the way, very soon this is going to be switched to SPX. GSPCs really should have been SPX, but it's an old ticker symbol used by our data provider. Okay. GSPC, it lost last year. Well, let's not look at this opportunity. These are very long-term, 241 days, 9 out of the last 10 years. Until June 7th, today to June 7th, it's made average of almost 11%. But it didn't work last year. But that's not what I wanted to look at. I want to look at this. Let's look at the last 50 years. I just want to look over here. So we'll take the statistics of last 50 years into account, and we look at trends in here. You see that? It goes sideways to down here in September, takes a jump up until around, so Right now it's the 10th right here, right? So seasonally, it takes a jump up and then it drops toward the end of October. You see that? So although it's not a sharp drop, because statistically S&P 500 doesn't really drop very frequently, but when it does, chances are high that it happens in September and October time frame. So what is this date? This is right here, is October 25. Markets or S&P 500 will be vulnerable until October 25. We consider October 25 a time that S&P 500 will turn bullish if things haven't dropped sharply. Okay, let's take a look at October. For last 90, let's take 90 years. Here's 90 years. Oh, actually that's 1932. Let's do more than that, so we have 1929 added to it. And then we say, let's take a look at month of September first. Do you see? In the last 94 years, September is a down month statistically for S&P 500. Look, this is 1929, 1930, 31, 32, 33, 34. So for these 6 years in a row, September just dropped. More currently, September was also a negative month in 2020, 2021, and this year also. Dropped 7.32%. September is just not a good month for S&P 500. But except for this 1931, I don't see a crash happening. You see that? There's like a 10% drop, 8% drop, 7%. This is month of September. How about October? In October, things are different. 1987, markets dropped 21%. How far did it really go? This is close to close from first day of October to last day. If we add MAE to it, we're going to see how much it really went. So take a look at 1929, month of October. It went 19.5 and 12.5. That's a lot. That's over 30%. In 87, it dropped in October. 22 and 2.7, so almost 24% in month of October. And in 2008, it dropped to 16.5, and then an additional 1.57, then it came back up. Other times it's been pretty okay. The reason I'm showing this to you is that month of October is a month that seems a lot of stock market quick drops have happened in month of October. And when does it happen? It happens here during this drop right there. Let's take a look at this drop. I am looking at October 20th to October 26th right now. This is a 7-day period. It dropped almost 14% in 2008. In 1929, it dropped almost 18%. This is within 7 days. So watch for this date. Until October 25th, 26th time frame, if we haven't had a crash, statistically it hasn't happened for a crash after that. So I would say keep very careful for next couple of weeks, look for October 25. That is a very key date. Now, when do markets turn bullish? Here, let's take a look. This is S&P 500. I believe it was 25th and 72 days. Let's take a look at what happens. Shut this off. Look at this. If you would have bought S&P 500 on the 25th and held it until January 4th, you would have made an average of 5.88%, 78% of the years for last 94 years, including 1929. These three were the outliers, anomalies. After 1931, this period was more solid. So let's cut those 4 years. I'm looking at 94. I'm going to switch to 90 to cut the 4 years on the left. Look at this. Last 90 years between October 25 and January 4th, S&P 500 has made an average of 5.78%, 80% of the years. That is 72 out of 90 years. 72 winners. The biggest one was 17.26%, I believe it's this one. 1962. Oh, that's before I was born. Last year it made 5%. The year before it made 8.8%. And in 2019, 7%. First, in 2018 it lost 6.4%, but then it made money. 2017, 2016, 2015 it lost 2.83%, but then look, 1, 2, 3, 4, 5, 6, 7, 8, 3, 4, 5, 6, 7, 8, 9, 10, 11. Let's look at the last 15 years. How did it do last 15? In the last 15 years, it was also 80% profitable. Let's cut that last one. Last 14 years. Last 14 years, it was 86% profitable. Sharp ratio is almost 1. That is not a bad one. So this period is a very good good time to keep in mind. Another thing about the S&P 500 is really good to know is this. People talk about January effect quite a bit. Let's go back to 90 years. Some people say January effect is January goes up, and some other people define January effect that small cap outperforms the big ticket items. So let's take a look at the overall market, S&P 500 in January. It's been profitable 59% of the time. That is not that good. The month that works better is December. Profitable 76% of the time. But how about small cap? Let's go to Russell. We have 34 years of Russell. If we look at the Russell in January, January was profitable 65% of the time for Russell, which is small caps. December, 79% of the time. I call this a December effect, not a January effect. January effect is not, I don't know, it's a myth, it seems to be. that does not compute. We'll talk about all the seasonality statements that people hear in some of the future videos, but this is a long video today, 20 minutes. But I thought I needed to share this. Okay, that's it for today. Don't go long for a couple of weeks unless it's one of those very few possibilities like Keurig is okay or Johnson & Johnson's okay, but it's better to wait a little. Even if the market goes up and there's some profit loss, statistically it's better to not be long for the next couple of weeks. But it's a great time for trying out some quick short option trades. Be back tomorrow.